A very good morning to all. Let's begin our today's session. My name is Swati Gupta and I'm a chartered accountant. I've been teaching to CA and ACCA students since last 3 years. I've been mentoring for financial reporting subject, which covers the in-depth knowledge of IFRS, Ind AS and IAS. So here also we'll be covering all the standards, do not worry, in detail one by one with examples. And if you're planning to go ahead with Diploma in IFRS exam, then definitely this course will help you a lot. Okay. Coming back to what will be there in this course. Okay, let's quickly understand what is IFRS, why IFRS come in. Okay, the question must be there with you all. There are so many times this question is asked that why IFRS, why it was introduced, because we already had IAS into picture. Okay, then how did it relate to Ind AS? Let me clear this. I would try to interlink them and then we'll go ahead with our main uh, standards. Okay. The first question that might arise is why IFRS? Okay, so there was Enron company in US, which was a very huge company and was dealing into oil and natural gas. Okay, now in 1992, it had a merger. From this merger, there were so many new CEOs and CFOs introduced. Then there was very important person, Jeff Skilling, that went into that was introduced in the board panel of the Enron company. Now, Enron company every year by year started new businesses, started new ventures and all. So Jeff Skilling suggested that whatever businesses are profitable, we'll only show them in the books of account. All the businesses which are not showing profits, we will not include in the CFS, will not include in the consolidated financial statements. Okay. So thereby, Jeff Skilling introduced this, proposed this, and the management agreed to the same. So while accounting, what they were doing, there were so many businesses, there were so many subsidiaries, new businesses coming up after the merger. They only showed all the profitable businesses. They did not show any loss-making business. Therein, what happened? Later, in 2001, the Enron company went into bankruptcy, was shut down, and was filed with the bankruptcy charges. Now, in 2001, there was a huge question on the entire financial reporting. Okay, there was a huge question that, okay, what are the accounts? They're not showing the exact representation. They're not showing the actual figures. Okay, they're not showing the right position. The company is making super losses, but the financials are pretty healthy, are showing super profits. Got it? So this is when IFRS came into picture. Okay. In 2003, Arthur Anderson, which was the CA firm, the auditor of Enron company, also went into liquidation. Right now, as you know, there are big fours: KPMG, Deloitte, EY, PwC. These are the big fours. Earlier, Arthur Anderson used to be the big four. But because of this Enron case, it was such a huge impact on the entire market as well as on the firm itself that Arthur and Anderson went into liquidation, was dissolved. Okay, so there was a huge question on financial reporting. We needed to improve. So earlier, IAS, International Accounting Standards, were there into picture, were there into application. Okay, it was given by IAS committee. Later, we felt that it is not sufficient. It is not giving right picture. It needs some amendments. It needs major changes as well as some critical small changes. So therein, IASB was formed and came into picture, kicked in, and said that, okay, let me take the charge. Let me introduce a separate a set of standards that is known as IFRS. IFRS stands for International Financial Reporting Standard. Okay, so what did IASB do? There was already existing list of standard that is known as IAS. Okay, if there were only minor changes required, there were only small amendments required, Then they did not abolish, they did not remove IAS. Instead, those IAS were into practice, into application, were not removed. Instead, some changes were made if minor changes were required. On the other hand, if the standard required super changes, I would say too much, entire standard needed to be changed, a new perspective needed to be added, then in that case, that particular standard was removed and instead replaced by a new standard that is known as IFRS. Okay, give me a quick thumbs up, give me a confirmation. Are you clear with this? Why there are two sets of standards? IAS and IFRS. Good. Okay. In the chat box, please confirm. Is it clear? Why there are two? Good, good, good. Okay. Okay. Now, what happened? In India, we also found the requirement of global standards, global reporting. Because if, as you know, nowadays cross-boundary transactions are super normal. Okay, the markets are so free that the boundaries are not restricting anymore. Okay, the country boundings, the geographical locations are no more a barrier. So therefore, companies are more interested in investing into those countries which are open, which are friendly, and it is so much easier to invest in those countries wherein the financials have same language, have same uniform patterns. So you're in to promote trade, to promote more clearer, better presentation. India also accepted global standards, that is IFRS. Okay, but the IFRS were accepted by the India, which are known as Ind AS, but they were not accepted as it is. India, though copied it from foreign countries, they were as it is accepted, but with some changes. With some changes. So India accepted this Ind AS, but it said that it is known as converged form of, it is known as converged form of IFRS. Converged simply means with some changes. Okay, with some changes. Please understand, we have accepted IAS and IFRS series as it is from the foreign country to maintain the global standards, to maintain uniform financial reporting, but with some changes so that in India it is more applicable, it is smoothly accepted. Okay, as we know, the economic conditions of all countries are different, may differ in some variety. Okay, so it has been converged. Now, what are these changes? These changes are known as curves. These changes are known as curves. If something has been added in the Ind AS, which was not present in IAS and IFRS, then we say that it's a carve in. Whereas on the other hand, if I say that something has been removed while preparing Ind AS, okay, this means it is present in IFRS, it is present in IAS, but something, some clause, some provision, some rule, guideline have been removed from Ind AS. Then we call this change as carve out. Okay, so there are total 41 standards, but right now, currently there are only 39 standards in applicability. Okay, so there are 24 IAS and 17 IFRS. Okay, when you look at this number, When you look at this number, you'll see that the series is not in a right sequence. Instead, some of these standards are eliminated. Okay. Why? Because they have been replaced by a new standard of series, that is IFRS. Okay. Wherein if we talk about IFRS, since it's a new standard, new set of standard, the entire series is in, I would say, right sequence. So there are total 41 standards. There are total 41 standards. Okay. Okay. Anybody, any doubt, any confusion, please confirm. All good? You can unmute and speak up. Good, good. Yes. Okay, good, good, good. Okay. Now if we talk about Ind AS, okay. Now Ind AS only has one list of standards. Okay, Ind AS only has one list of standards. Okay. This means how do you identify whether it is from IAS or whether it is from IFRS? Okay, India has only one set of standards, one list of standards, that is Indian accounting standard known as Ind AS. How do you identify, how do you differentiate whether it is from IAS or whether it is from IFRS? Okay, for this, India has said that, okay, MCA said that while numbering, if it is from IAS, we'll keep the same number. Whereas in case if it is from IFRS, okay, then we'll keep the numbering in 100 plus series. For example, if it is IAS 1, then we'll say it is Ind AS 1. If it is IAS 2, then we'll say it's Ind AS 2. Same numbering, same pattern. Whereas if we talk about IFRS, if it is IFRS 1, then while accepting in India, in order to differentiate, segregate both the list of standards, we said that let's say Ind AS, not just one, but 100 plus series, that is 101. For example, if it is IFRS 2, it will be Ind AS 10. Okay. Therefore, you could see that in our Ind AS, you have numbering till 116, 117. Do not think like we have 117 standards into applicability. No. The standards are only 41, out of which 39 are applicable till for the current situation. Okay. The numbering pattern is differentiated in order to segregate from IAS and IFRS. Okay. If you want, you can note it down simultaneously. Otherwise, these notes will be available on the app itself. Okay, it will be uploaded in the course in the PDF format, and these I would say notes can be downloaded in your device. You can keep it downloaded for your future reference. Also, the same course will be available in Hindi as well. Good, good. Okay, so if you want to take a simultaneous note, good. If no, then it's fine. The same will be available in the. Okay. Was this story interesting? Did you find it interesting and I would say informative? Any question, any of your doubt? Good, good, good. Good question. Any of your doubt, any cross question? Yes?
No doubt.
Good? Okay. 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 Out of you, anybody is aiming to clear Diploma in IFRS exam, which is taken by ACCA. There is only one single exam that you need to write regarding financial reporting.
I am planning, but I'm not sure at this point in time.
Okay, sure, sure, sure. But by the end of this, yes, Kishan.
If in complete, I will just. I'm planning to complete this in December because I have shared my story on website.
Yes. Okay, good. So I'll quickly tell you how the paper works. Okay, ACCA diploma. This is just one single exam. Okay, just one single exam is there, which is of 100 marks. Okay, single exam, one paper. It is of 100 marks. Okay, it is of 100 marks. It is entirely computer based exam, online exam. Okay, it is entirely computer based exam, online exam. Okay, online via internet. Now there are two options in this. Either you can go ahead with center based exam. Okay, there are multiple centers allocated by the ACCA all around the world. You can pick any center, any of your nearest and convenient center, and go and give your exam in the computer over there. Otherwise, you can also choose remote location. That means you can use your own laptop, okay, from the convenience of your home itself, and then take up the exam, okay, on the stipulated time and date. Now, the exam is always conducted only twice a year, that is in June and September. Sorry, December. Only June and December. Okay. Uh, so like one month before itself, like 29 April was the last date to, I would say, apply and register for June. Now, approximately 30th or 29th October will be the last date to register for the December exam. Also, I'll update the same when the, uh, I would say, time period comes near. Now, the entire paper is of 100 marks, and there are four big questions asked. Four questions asked, and each question is of 25 marks. Okay, so this means there are no objective questions. No objective questions. Okay, there will be no MCQ fill in the blank. Instead, you will be required to answer each and every question in detail, either in the paragraph form or in the Excel form. Okay, no objective questions. One more pointer, there is no, I would say, uh, no negative marking. This 25 mark question might have 2-3 parts, okay, but there are only four major questions. Okay, entirely you have to apply it on the, I would say, computer based exam. Okay, now there is a response area in which you have to provide your answers. Okay, there are no optional questions. No optional question. It won't be like, for example, in our graduation, what happens, there are two questions, either of them we need to attempt. There are options given between two or three questions, and we need to choose which one we want to answer, and then we answer. Herein there are no options given. And what is the pass percentage? 50%. 50% is pass percentage. Okay, anybody any doubt regarding this paper? Okay, this is acca.global.com. When you log in this, okay, there is student tab. You can click on student tab. If you scroll down, there is a study support resource. Okay, you can click on this. Now, ACC has its own qualification, entire degree, as well as only one single diploma can be claimed. So we are learning about DipIFR. Okay, diploma in international financial reporting. So if you select on this, there are so many, I would say, options already given. What is the syllabus? What are the documents? How the exam looks like? What are your past papers? So, for example, past paper. If you look at this, you can quickly take a note of the same. There is 3 hour time given. For example, if you click on this, you'll see how your exam portal looks like. Okay, so this is the time period, information given. When you click on next, these are all, I would say, information given about the computer based exam. Okay, we can get back to this later. Also, students who are, I would say, aiming to clear diploma in IFRS will have separate session for the same to practice on the computer. Okay, like, okay, how to approach the paper. So for example, this is question number 1. See, this exhibits tell you what are the case study, what is the scenario, okay, what are the information given in the question. This tells you the requirement, what is the requirement of the question. So these are the 3 pointers that you need to explain to get 25 marks. Okay, and this is the response area. This is where you write your answer. Okay, so for example, your spreadsheet is required. You'll be writing your answer in this spreadsheet. Okay, everybody clear? This is a case study information regarding the question. This is the requirement that you need to answer to score 25 marks. And this is the area where you write your answer. So this is how your exam screen will look like. Give me a quick thumbs up. Anybody, any cross question can ask. Okay, from the navigator, good, good, good. From the navigator, you can look at this. Okay, like there are 4 questions. Right now I've started this and it is unattempted. So herein you get the status. Once you attempt it, here it gets attempted. So in case first you have answered second question, then you can come back to the first one. Okay, good, good, very good. Okay, I think we are good to start with our okay. So there are 39 standards that we will cover. Even in diploma in IFRS, there are 1 or 2 standards that are eliminated, that are not part of your syllabus. Like for example, cash flow statement. So diploma in IFRS never talks about cash flow statement and does not include any questions related to that. But still, do not worry, we'll cover that. Also, diploma in IFRS does not talks about, I would say, does not talk about Ind AS. It does not refer Ind AS. But in this course, we will simultaneously take the reference of Ind AS. If there are any differences, any curves, I'll let you know simultaneously. Okay. So I would say we are covering more than diploma in IFRS. So we'll firstly start with property, plant and equipment, that is IAS 16. Okay, IAS 16 is very equivalent to Ind AS 16. Since it is derived from IAS 16, the numbering remains same. It is very popular standard, that is property, plant and equipment, which is known as PPE. Okay, now what happens? Earlier, before this IFRS, IAS and Ind AS were introduced, we used to follow AS, accounting standard. Therein, if you could remember, there was a standard known as fixed asset. Do you remember? Fixed asset standard.
Yeah, AS10.
AS10, AS10. Kishan, there was AS10 wherein we used to club in all the standards or all the fixed asset. Any asset that is used for more than 1 year was treated as fixed asset. There were only 2 types of asset, current asset or fixed asset. Here, IFRS, Ind AS has brought in a more, I would say, larger perspective. In order to provide better picture, in order to improve presentation, the standards are further divided, and it is divided on the nature of use. For example, it's a fixed asset. If it is being used for business purpose, for further production, for further supply of the services, etc., if it is being used in the business purpose, then that asset will be categorized under IAS 16 and will apply all the provisions, all the guidelines given under property, plant and equipment standard. Okay. Whereas if we talk about it's a fixed asset, definitely it will be used for more than a one period. Got it? Long-term assets, fixed assets, if it has an intention of just collecting rentals or capital appreciation. For example, you have bought a land, okay, and you feel like, okay, 10 years later when this highway will be constructed, okay, things will change, economic conditions will change, therein you will sell this land and become a billionaire. Okay, this is your idea behind purchasing this asset. Okay, then this is known as investment property. You have no intention to use it for business purpose. Instead, your intention is either to collect rent from the same or get the benefit, get some profits, okay, due to capital appreciation, due to change in the value, okay, or you can say the difference between sale and the cost price. Got it? So herein, in the entire IFRS, in the entire Ind AS, the major change is to look at the perspective, to look at the intention. Okay, the name does not suggest where it will be classified. Instead, the nature of use suggests where it will be classified. Okay, everybody clear? Give me a quick thumbs up. Everybody clear? The idea, the intention behind this, good. Okay, give me good, good. Okay, the idea behind, the intention behind this, okay, tells you how to bifurcate. For example, just for example, I have a balance sheet. Okay, herein, for example, it's asset side. Just an example. So herein, there will be two categories. Under non-current asset, okay, we'll have two categories, property, plant and equipment and investment property. Later, we'll read about investment property also in the next class itself. But anything that has nature of business, that is being used in business will be written over here. And anything that is used with the intention of collecting rentals will be classified over here. So therein the balance sheet, on the face of balance sheet, it will be super clear what is the intention, okay, of the asset. So this classification is done for better categorization, for better presentation. Okay. Okay. Now coming back to the definition. See, to understand this entire standard, we really need to understand small critical definition. I will not go into the technical jargons. Instead, we'll try to simplify it as much as possible. Okay. So any asset that is being held for any production or supply purpose, okay, so, production of goods and services, if it is being used for production purpose or supply of any goods and services, they or for rental to others. Rental to other means the business is of renting out. For example, you have a logistics business and you are the owner of 10 trucks and your business is to provide trucks on rent. For example, you are tour and traveler, you have a tour and travel business and you have, for example, 10 luxury buses, okay, and you provide those buses on rentals. Got it? So if your business is of rental, then only it will be classified under PP. If you're collecting rent, only rent, and it's not your core business, then it will be classified as investment property. So reading IAS 16 and investment property, that is IAS 40, are very, I would say, gives more clear picture if we compare them both simultaneously. Do not get confused. So if you're using for business purpose, or if your business is of renting out, and if you're using that asset for that renting business, or for administrative purpose. Administrative purpose means head office. For example, you're not manufacturing something over there. Instead, you are making the admin part over there. Okay, you are making sure everything is in right place. What are the allocation, funds, everything, accounts are being managed. Okay, if that asset is being used for the administrative purpose, then also it will be classified under property, plant and equipment. You have to record in the books of asset as per IAS 60. A quick thumbs up. Are we clear for this definition? And expected to be used for more than one period. That means long-term asset. Good, good, good. It should be used for business, either for production or for supply. Okay. Or if your business is of collecting rents, and then if you're using that asset for renting business, then go ahead with the PPE classification. Also, in case if you're using any asset, if the intention for use of the asset is for the office purpose, for the admin purpose, okay, then again you have to classify it as PPE, property, plant and equipment. Okay. Now, recognition criteria. Recognition criteria. What is recognition criteria? Recognition criteria means when will you record in the books of asset. Whereas derecognition criteria means when will you remove from the assets. Recognition simply means passing a journal entry and recording the asset in the books of account. Whereas derecognition simply means removing from books of account, passing a reversal journal entry. Everybody clear with journal and reversal? Good. Journal entry and reversal journal entry. Good. Okay. So if you want, if anybody, any item satisfies the definition of recognition criteria, then simply you have to pass a journal entry and bring that asset in the books of account, pass a journal entry. Whereas if any asset, any item satisfies the criteria of derecognition, then simply you need to remove from books of account. This means you have to pass a reversal journal entry. Okay. What is the recognition criteria? To recognize a PPE in the books of account, it's a simple criteria that you are required to have a probable future economic benefit. This means it should not be that certainly it will make profits. There might be possible that you have installed a machine for the production purpose, but 6 months later, it is going into losses. It is not able to make profits. Still, that machine will be capitalized and recorded as PPE because the intention is to produce and supply, is being used in business. Got it? Check the words. It is known as probable. That means when you're purchasing, when you're recognizing, it should be an expectation. There should be some chances that there will be economic benefits. There will be some profits either in cash or kind, but there will be some profitability that will arise from that particular asset. Secondly, it is very important to ascertain the cost of the same. You have to record it at cost. Then the cost should be reliably estimated. It could be calculated. Okay. The cost of PPE can be reliably measured. These are only two circumstances, two conditions that need to be identified, that need to be satisfied in order to bring any asset in the books of account. Anybody, any doubt? Also, it will flow to the entity. This means if any benefits that arise from that machine, entity is the one, the company is the one that will be entitled to gain that benefit. Okay. Probable benefits means there should be chances of earning profits, and these profits will go into the pockets of company, into the owner pocket. And secondly, you can reliably estimate cost. Anybody, any doubt? A quick thumbs up, please. Or you can ask doubt if any. Good. Good, good. Okay, next. Now, if we talk about cost, there are so many items of cost. Okay. There is a list of cost. Now, one thing that you need to identify, that you need to keep in mind is ready for use. Ready for use. As soon as the asset is ready for use, you stop capitalization. You stop adding any cost to the books of account to that PPE. Instead, any cost that is incurred afterwards, that will be charged to PL. See, there are only two options. If you have incurred any expense, then there are only two options. Either you can debit it in asset, okay, side, or you can provide a debit in PL. Only there are two options. Whenever there is an expense, there are only two options. Either you can record it as an asset, or you can go ahead and charge it into the PL as an expense, as a simple expense. Okay. Now you are allowed to debit it in the asset. This is known as capitalization. This is known as capitalization. You can add the cost into the books of account. You can add the cost into the asset only till the time the asset is ready for use. Please mark these words, ready for use. For example, it's ready for use today itself, but you have no intention to use it before 1st July. Okay. For example, the asset is ready for use today itself, but you will be using it from 1st January itself. Got it? It does not matter. As soon as the asset is ready for use state, you have to stop capitalization. Okay. Now, if we talk about price, we talk about cost, the price that you have paid. Now, it has so many taxes, so many items, whether it should be included or not, whether they should form part of the, I would say, whether they should form part of the cost or not. Okay, it depends. If it's a trade discount, do you know what is trade discount? Anybody? What is trade discount? Anybody, any idea? What is trade discount and what is cash discount? You must have read it about the same in your basic 11th and 12th standard. Do you remember? Anybody? Yes.
See, trade discount is generally commercial call that the businessman takes.
Okay. Okay.
Cash
So this
discount
is
is the volume discount.
volume discount. Okay. It is given at the point of sale.
Sale
It is
volume.
given at the point of sale.
Okay.
Okay. Yes, it's a volume discount. If somebody is purchasing in a higher quantity, then they can bargain and say that, okay, instead of charging this, you can charge a little lesser amount. So the discount that the buyer gets on the point, okay, on the point of sale, due to bulk purchase, due to volume quantity purchase, then this is known as trade discount. The standard says that trade discount is eligible to be deducted from the cost. For example, if you have paid 10 rupees, just an example, then, and for example, it's a trade discount of 1%, then, or sorry, 10%. Okay, then you can deduct 1 from the same and you can record your cost at 9. Cost to be recorded in books. Got it? Trade discounts are eligible for deduction. Trade discounts are eligible for deduction. They will be adjusted in case if the if the price is given after discount, okay, good, no adjustment required. But if the price is given, the list price without the discount, then you have to record it after discount. Question clear? Good. Okay. In case of any doubt, please ask. Whereas if we talk about any cash discount that comes up later, cash discount is your settlement discount. Trade discount is your volume discount that happens on the point of sale. Any cash discount that will come up, maybe if you're, for example, it's a credit purchase and if you're settling it 2 months later, the cash discount will be entitled 2 months later. So right now we say that cash discounts are not deductible. For example, later, if you're getting, just an example, okay, if you're getting a discount while payment, cash discount, okay, For example, again of 2 rupees. We say that this is not deductible. Instead, the cost will still remain 9 itself. You will not go back to your PPE and deduct the amount from PPE. Got it? No. The cash discounts are not eligible for being deducted, but straight discounts are eligible for being deducted. Okay? Everybody clear with this pointer? Purchase price less trade discount or rebate. This is given at the point of sale. Please raise hand in case of doubt. Please unmute in case of doubt. Okay, here also I have given a quick note of summarized note so that there is no more confusion. If there is a trade discount, it's given on the bulk purchase. Yes, please deduct it from the list price from the PPE cost of asset. Allowed. Whereas if we talk about cash discount, not allowed. Please do not deduct it from the cost of asset. Okay. Next comes import duties. Next comes non-refundable purchase taxes. Okay. What does these mean? Just an example. Please let me know. For example, the price that is of 100 rupee, and for example you are paying GST for purchasing the same, that is 12 rupees. Okay, this means the price that you have paid is 112. Please tell me, what is your cost? Is it 100 or is it 112? If you have bought a PPE at rupees 100 with a GST payment of 12 rupees and you have paid a price out of your pocket that is 112, please tell me, the PPE will be recorded in the books of account either at 100 or 112. Kishan says 112. Okay. What about Harishankar? Mehak, any guesses? Good. Harishankar says 100 as cost and input GST of 12. Okay. Okay. What else? Okay. So I would say instead of one correct answer, it depends. It depends if you are eligible for ITC or not. For example, me being not a registered seller on the GST, okay, I am not registered with GST. Then, in case if I pay any amount of GST, then I'm not given any input benefit. I cannot take any input benefit. Instead, that GST amount is the final outflow from my pocket. I'm the final bearer of that GST amount, and I cannot claim an input. Whereas if we talk about any other buyer, okay, any other business who is a registered business with GST and can claim input tax credit, can claim ITC, input tax credit of the GST, and can use it further for the set up with the output tax of GST, then in that case it will differ. Okay, if you are eligible for GST output, GST input, okay, there can be two cases, yes or no. Okay, if you are eligible for GST input, okay, then record PPE at 100 and record input tax credit at 12. So that's how your asset total will be 112. Okay, and no, if you're not getting any input further, then record PPE at 112, because this 12 rupee is ultimate outflow from your pocket. It's a price that you're bearing. You will not be getting any set of for the same. You'll not be getting any further carry forward for the same. Give me a quick thumbs up. Are we clear? Are we good till here? Good, good. Good. Okay. So sometimes question says, sometimes there are situations. So you have to firstly check whether it's a refundable tax or not. Okay. This ITC is also known as, okay, for reference purpose, it is also known as refundable tax. Definitely, it does not come into your bank account, but this is further adjusted, and therefore, this is sometimes, I would say, claimed as, recorded as refundable tax. Okay, so in case if you have refundable tax, please record it as separate asset. Do not include it under the PPE cost while recognizing in the books of account. But in case if it's a non-refundable tax, then we'll say okay, record PPE at 1/1. Okay, again coming back to the same. For example, import duties, if they are non-refundable. If you have any other non-refundable taxes, then go ahead and include in your cost of PPE. If there are any refundable tax, we say do not include. Okay, record it as separate asset. Good, very good. Okay, next question. There are so many costs. How do you segregate? There are so many costs available. How do you segregate which one to capitalize and which one not to? Okay, any cost that has been incurred that was necessary, that was unavoidable to bring the asset in a position which is ready for use, in to bring that asset to a condition which is ready for use, those costs are eligible for capitalization. Those costs are eligible for capitalization, can be added to the PP. Any costs that are unnecessary, that can be avoided, okay, that are not required to bring that asset into ready for use condition, then those will not be capitalized. Let's look at some example. Okay, working condition, or you can say ready for use. Example, employee benefit costs. See, these are the employees that are specifically targeted, that are specifically, I would say, allocated and invested in purchasing the asset. Okay, in purchasing the asset. Okay, they are the ones who are guiding the same. For example, if you want to purchase a new factory and set up a new factory in Chennai. Okay, now, for example, I am from Jaipur. I don't know much about Chennai. Okay, also I am from commerce background, but for setting up a factory, we need some engineering and science knowledge. Okay, I need to have very technical knowledge in order to identify which area is more suitable, which type of machines are more, I would say, productive, better. Then in that case, I'll hire some expert either from outside or from in-house, and I'll say that okay, this and this expert, my technical engineer, go and let me know where to situate and what is the machine that we should bring up. Okay, now if any inside employee or any outsider, if they're thoroughly being invested, are being I would say recruited, are being allocated, invested in identifying that machine, in bringing that machine, in buying that machine, then those costs are also being capitalized. Any site preparation. Okay, just a quick, okay, Kishan, just a quick update. For example, if any employee, either it's in-house or recruited from outside, okay, if any employee has been picked up and they are thoroughly being invested, thoroughly being helping for recruiting of that PPE, then you have to capitalize that amount. Okay, any site preparation. See, if the factory is not ready, if the site is not ready, can you use that machine? For example, you want to set up a furnace. Okay, if you want to install a machine, if the place is not ready, can you bring that asset into working condition? No. The site preparation is prerequisite. It's required, it's necessary, it's unavoidable. Therefore, you will capitalize. Next, initial delivery and handling cost. This will also be capitalized because it's unavoidable, it's important. Next, installation and assembly cost. Again, without assembly, without installation, the PPE won't be in a ready for use state. Next, professional fees. If you have hired any technical expert from outside and are paying any professional fees for the same, for the consultancy, then that fees will also be capitalized. Any cost of testing. Before going ahead with the mass production, for example, you've installed a machine today, and for example, the machine has a capacity to produce 1 lakh units. Okay. Will you go for the mass production on the day one? No. Instead, you make some trials, some more experiments, and check which is the right combination, which is the right state, what are the right measurements, data. Okay. At what point the machine is using at the best, is producing very well. Okay, you make some sample testing, some experiment. Once you're clear that okay, the sample is up to the mark, it has passed all the quality checks, then only you go ahead with the mass production. Got it? So this is known as testing. Cost of testing is also super important in order to make sure whether the machine is in a condition ready for use or not. Everybody clear? Give me a quick thumbs up. Ishan, any doubt? Confirm once. Okay, so any samples that you have created, you have produced in order to make sure whether the machine is up to the mark or not, whether the machine is ready for mass production or not. Okay, that cost will also be capitalized. Any site restoration and provision, I'll tell you what is this. Right now, if we talk about cost of testing, okay, samples you have tested. For example, there was sample testing, okay, and sample testing cost. And for example, rupees 10,000 have been incurred. Okay, 10,000 rupees have been incurred in this product sampling, testing, experimenting. Okay, this will be capitalized. We say this will be capitalized. Okay, this means add to PPE. Whereas, for example, there will be some scrap out of this production. Maybe the costs that have been incurred, the samples are not up to the mark. Okay, they will not be able to be. I would say they are not in a situation to be sold in the open market. They cannot be sold because they are not up to the correct quality, up to the mark. But they might be sold at some scrap. They might be sold at some scrap, and might be the company has received, for example, 1,500 rupees. Okay, we say that this 1,500 rupee will not be capitalized. Okay, do not capitalize or net it off. Instead, this 1,500 will be charged to PL statement. Got it? Any scrap value that you're deriving by selling off the sample units, the tested units that were produced while the quality checks, okay, this will be charged to PL as gain. This will not be deducted from cost of asset. This will not be netted off from cost of asset. Give me a quick thumbs up. Do you agree? Do you understand this? Good, good. Okay. So there are many questions which tell you there is testing cost. Please capitalize. Go ahead because it is super important. It is unavoidable. Why the scrap value is not being netted off? See, firstly, selling off scrap is not necessary for bringing the asset ready for use. Okay, without selling the scrap also, the machine can work, can be brought to the working condition. Got it. Secondly, we do not know when it will happen. Scrap can be sold 2 years later, 5 years later. It can be sold the next day itself. We do not know when the scrap will be sold off. Okay, we do not know whether at what amount it will be sold off. Okay, at what time, at what amount. Also, it is not necessarily required that if somebody does not sell the scrap, then they will not be able to use the machine. Okay, so since it's avoidable, scrap sale is unavoidable. Sorry, is avoidable. Therefore, we are saying that do not capitalize, do not deduct it from the PPE amount. Okay, I think we can take a 5 minute break. Okay, get up a little, roam around. Okay, and then we'll continue our uh, session. Okay, just for the relaxation purpose, we'll connect back at 8:10. Okay, all right. Okay, good, good. Okay, we'll connect back at 8:10. Okay, do not leave the session. Keep it on. It's fine. Okay, please confirm, are we back? Can we continue? Okay, good. Okay. So next topic. Okay, we were discussing about the cost that can be capitalized. So trade discount, can it be capitalized? Yes or no? Will this be deducted or no? Yes. Okay. If I talk about cash discount, can you deduct cash discount from PPE cost? Okay. So trade discount will be deducted, yes. Cash discount will not be deducted. Okay. If we talk about any expense that is necessary for bringing the asset ready for use, will this be added to PPE or not? Krishan got confused. Krishan, unmute and speak up. What is your confusion?
Like I might be used with this topic. And do we include this or not?
The topics are
Like the one this that you said, employee benefits and all. Do we include?
these, yes, these will be included. Yes, this will be included. Included means, yes, it will be added to PPE, property, plant, and equipment. The employee benefit cost, not the of entire company, the employee benefit cost that is directly related to that particular PPE will be capitalized, will be added to the cost of PPE. Is it clear?
Yes.
Okay, good. Okay. Okay, next, cost of testing. Will it be added to PPE? Cost of testing, will it be added to PPE? Okay, good. If I talk about, if I have sold those samples, okay, which were not up to the quality, and I've got a scrap value of, for example, 1,000 rupees, will I be able to deduct it from the PPE? No, Harishankar, no. No. Good question. You will not be allowed to deduct it from PP. It will not be netted off from PP. Instead, it will be charged to PP. It will be charged to PL. Okay. And we have already taken an example. Okay. If you are earning any amount later because of the scrap value, then please charge it to PL. It will not be deducted from PPE. Okay. Next, last topic, that is site restoration provision. That is as per IS 37. Do not worry, we'll be reading IS 37 in detail. But right now, it is relevant. And why? See, what is site restoration provision? Simply, for example, you are into a project. You have a site and you are building up a new project. Okay, for example, you are building a new tower. Therein, for example, it will take 2 years to build that tower, that facility. Meanwhile, for 2 years, what happens? You use the surrounding area. You build up some temporary huts so that labor could stay in. There are some temporary huge machines installed, okay, so that the work of building can be done. Got it? Construction work can be continued, can be done with the efficiency. But after 2 years, it is the responsibility to bring that site back to the original condition. Whatever harm, whatever damages that you've done, you are required to compensate the same to clear the same. For example, you have done air pollution. You are required to clear that air, okay, again by planting more trees and all. For example, you have built in temporary homes and huts, okay, for the labor. After construction work is completed, you are required, it's your obligation to remove those temporary huts and all, okay, temporary tents and all, okay. Another example, for example, your work is to extract petroleum from earth. So you whenever you find that okay, there is petroleum in this area, what do? You are required to install a huge drilling machine, extraction machine, okay. For example, this extraction work will take for example 2 years. After 2 years, your obligation is to dismantle, remove that machine and bring that asset back to the original condition. This is known as site restoration provision, okay. Since this is a cost which will be incurred at the end of the project, the company knows that it is statutory or its social obligation that it is required to clear and bring that site back to the original condition at the end of the project. But since this obligation is known at the beginning of the project itself, okay, this is a cost that will be incurred 2 years later, but at the start of the project itself, you know that you have to incur a cost. For example, to dismantle the oil drilling machine, petroleum extraction machine, it will take 50,000 rupees. For example, to remove all those temporary tents around the building, for example, it will take 1 lakh rupees. This is a cost that will be incurred 2 years later at the end of the project, but this is known today itself, okay. Now, being an accountant, we always follow conservative approach. We always follow prudence approach, which says that if there are any expected expenses, any expected losses, please book them now itself. In case if there are any future incomes, gains, please ignore them. Got it? So on the basis of this, we say that if there is any expected cost, if there is any future obligation, any future expenses, let's book it today itself. Therefore, we are creating a provision. Everybody, please confirm, are you clear? What is site restoration and why we are creating its provision? What is site restoration? To bring that area back to its original condition, to dismantle all the machines, heavy machines, to dismantle all the temporary tents, okay. And why we are creating provision? Because it's a future cost, but it's known in the beginning itself. Please confirm, are you clear what is site restoration provision? Good. Kishan, please confirm.
Yes,
Good?
clear.
Okay, good. So this is done as per IS 37. This is also known as dismantling provision. Sometimes it is also known as decommissioning provision. Sometimes it is also known as site restoration. These all are one and the same thing. This all means that you need to bring that place back to the original condition. Okay. Expenses that will be incurred by the entity at a future date. It's a future obligation because of any law or because of the social responsibility. But this is a cost that is known in the beginning of the project itself. Following the prudence approach, let's record that asset. Let's record that future expense today itself. So you will be capitalizing this provision. Okay. And how do you calculate a provision? You will be calculating using present value factor. I'll tell you when the question comes up how to calculate present value. But right now, please understand, you have to record the asset at, you have to record the dismantle and site restoration provision at present value. Okay. Please raise hand in case of doubt. Now, a quick suggestion, if you are preparing for Diploma in IFRS and if you aim to take up the exam, I would recommend try to take down notes, okay, simultaneously along with the lecture. This will help you a lot while doing revision. Okay. Undoubtedly, these will be uploaded. This will be available in the soft copies in your app. But it is suggested to make I would say make your own notes while during the session. Okay. See, so we have covered everything. We have covered first thing, purchase price, rebates, okay, all the refundable taxes, non-refundable taxes, all the costs that were required for ready for use condition. Third comes capitalization of finance cost, any amount that you have borrowed to purchase that asset, to construct that asset. Then that finance cost, the interest cost, what to do. We'll read it later when we study IS 23 because it depends upon some conditions whether to add to the PP or not. Right now, for time being, let's drop this topic. We'll take it later once we complete our IAS 16 and IS 40. Then we'll go ahead with IS 23. That will tell you about interest expenses, whether they should be capitalized or not. Okay. Next. Now, there are sometimes a list of costs given. This is not an exclusive list. This means any item out of this will not be considered under this list. No, it's just an example. These are lists given of examples which will not form part of your PPE, which will not be capitalized. Okay, these are normally why? The simple idea is that because these are avoidable, or you can say not necessary to bring the asset in condition, okay, of ready for use. Just an example, if you do not do any inauguration function, if you do not hold an inauguration function, still that machine is capable of working. Got it? Inauguration function is not, I would say the working of machine is not dependent on any inauguration function. Got it? So cost of opening a new facility, cost of introducing any new product or service, cost of conducting business in a new location or with a new class of customer. These are all expansion, inauguration, etc. These expenses will be charged to PL. Charge to PL. Do not capitalize. Fourth one, administration and other journal overheads. Okay, these are should be charged to PL. These are general overheads. Always, one more thing, never add any allocated expense. Never add any allocated expense to asset. Always actual expenses will be added, allocated expenses will not be added. There are questions which tell you a list of expenses and the expenses include any allocated expenses. Then allocated expenses will be ignored, will not be capitalized, will not be added to the cost of the asset. These are general overheads. You know, there are direct costs as well as indirect costs. Indirect costs which are not directly related, which are just attributed, okay, which is just allocated on some I would say appropriate basis, then these are not capitalized, not added to the cost of the asset. Cost incurred when an item was capable of operating has not yet been brought into use, being used at less than full capacity. If something is not being used at full capacity, then that is abnormal loss. Abnormal loss is always charged to PL. Always charged to PL, never capitalize. Next, initial operating losses. See, operating losses, never create a provision, never record any a loss into the PPE. See, you have bought a machine, you have installed that machine, okay, and you have tried and tested and made some samples and said that, okay, it's good to go. Till that point in time, all the expenses will be capitalized, will be added to PPE. Right after that, for example, for 1 month, you have manufactured 1 lakh units but this is not going into profits. The initial expenses are so high that it is not able to cover up. Got it? So initial operating losses that happens right after the machine is ready for use, right after that, these are never eligible for capitalization, because this takes place after the machine is ready to use, after the PPE is ready for use. Clear? Next, cost of any relocating or reorganizing part of the entity's business. For example, the company is being shifted from one place to another. You are relocating the staff, you're retraining your staff, etc. Then these will not be capitalized. Got it? Even training of staff is not added to the PPE. Why? Because even without training, the machine is in a working condition. The machine is ready for use. Anybody, any cross question? Anybody, any cross question?
I just wanted to know the structure. We like this price is for asset, like
Yes.
just for machinery. Got it.
Yes,
Means
this
every
part
cost.
is, yes. Okay, we are talking about, since we discussed about, see, we have started with PPE, property, plant and equipment. We said that it's a long-term asset. If it's being used for the business purpose, we'll classify it as PPE and we will apply IAS 16. Now, IAS 16 says that record at cost model, and if you're recording at cost, it should be reliably measurable. Now, what are the costs that can be included in the cost of PPE while recording in the books of account? These are the list of costs that will be included. It also says that there are list of items which should not be included in the cost of asset, in the cost of PPE, when we are recording it in the books of account. So for example, if you've got any inauguration expense, instead of recording as a part of PPE, instead of adding to the cost of PPE, rather charge it to PL as an expense. Is it clear? Okay. Entire concept is running around an asset that is being used for business purpose. And any asset that is being used for business purpose is classified as PPE and we have to apply IAS 16. So IAS 16, we are trying to read IAS 16 and understand what are the items that will be added, what are the items that will not be added to the cost of the asset. Okay. And if you're not adding to asset, but you have to record it somewhere, so you'll simply charge to PL directly. Okay, PL account. Next. Okay, we've already read this. For example, a cost is incurred for testing before it's ready for use. Okay, it will be capitalized, but any amount that is being received, any proceeds that have been earned by selling those items will be charged to PL as any other income. We've already discussed this example. Okay, last, next. Super interesting part, that is statement of PL and OCI. Okay, statement of P&L and other comprehensive income. Generally, when we do not apply Ind AS and IFRS, we have a simple statement known as P&L statement, or you can say trading and PL statement. Okay, wherein trading account was related to your sales, closing stock, purchase, okay, your opening stock, and the difference was treated as gross profit. It was later carried forward to the PL account. Therein we have opening GP, then we deducted all the expenses, and therein we had a net profit. Got it? Initially, it was trading and PL account. Now it is known as statement of PL and OCI. OCI stands for other comprehensive income. See, again, just to highlight, it says PL and OCI. This means your statement will have one portion as PL as well as another portion as other comprehensive income. Okay. This is the structure of your PL and OCI statement. All the incomes are added, all the expenses are deducted. Then you get a profit, that is profit before taxes. Then you deduct taxes related to the items of PL from the PL itself. Then the amount that comes up is known as PAT, profit after tax. Okay. After that, there is a separate heading in your statement of PL and OCI, which is known as other comprehensive income. Now there are its own incomes and own expenses, and any taxes related to those incomes and expenses under OCI will be charged and deducted from the OCI itself. Okay. The total of PL and OCI is known as total comprehensive income, TCI. This is total of PL plus OCI. Okay. Now the question arises, why two parts? Second question arises, what are the list of items, what are the list of incomes and expenses that can be charged to OCI? Third question, it might arise that, are we having any choice whether to charge to PL and OCI, or is it stipulated, it has been stated in the standard itself? Okay. And another question that might arise is, why OCI? Okay. Any other expense, any other question other than this? Do you understand the structure of statement of PL and OCI? It has two major parts, PL, OCI. PL has its own incomes and expenses, profits, taxes. OCI has its own incomes and expenses and taxes. Good, good. Okay. Now what happens? Standard prescribes specific situations wherein specific income or expense will be charged under OCI. Otherwise, in general cases, all incomes and expenses are recorded under PL. Got it? We say that if a standard specifically says that please charge this item under OCI, then only you will be charging that income, expense, and tax under OCI. Otherwise, in general cases, everything is charged to PL unless specifically stated under any respective standard. Give me a quick thumbs up. You do not have a choice. Okay, it's not on voluntary basis that you can decide whether to charge to PL or OCI. Instead, it's given in the standard. If standard says specifically that please record under OCI, then go under OCI. Otherwise, please record under PL. Now the question arises, why OCI? We were very happy and comfortable with a simple statement known as PL. All the expenses and incomes and taxes were charged under PL. We were very happy and comfortable with the same simple accounting. Now, why OCI has been introduced? Okay, why other comprehensive income? Now, what happens as compared to your accounting standards, previous gaps, etc., and if you weigh it along, if you compare it along with the see, this is entire statement. Okay, along with PP. Any income, if you're earning from any sale, any rent income, any dividend income will be charged. Okay, so this statement of PL and OCI is the overall part of financial statement. Okay, Kishan? It's not only related to PP. I'm just explaining this because again, ahead of this, we'll be using PL and OCI repeatedly. So you should know what is PL and what is OCI. Kishan, please confirm. Okay, good. Okay. Okay. Hari Shankar, what do you want me to repeat?
You explained it. I'm okay.
Explain.
You explained it. I'm okay now.
Okay, good. Okay. Now the question arises, why OCI? Okay. As compared to our previous GAAP accounting standard, therein the fair valuation concept was not there. If it was there, it was very rare chances wherein you were required to remeasure, revalue, and fair value. Okay. Whereas in IFRS, it talks about most updated value. It tells at many places, it tells you to do the fair valuation, to conduct the fair valuation. Okay. Any gains that are arising, any losses that are arising due to fair valuation are notional gains. Are only gains for the booking purpose, for the recording purpose. These are not actual gains. These are not real gains. Got it. So, in order to secure our PL and show only the actual incomes and expenses, the OCI has been developed and introduced, and it says that all the notional incomes and expenses, okay, should be charged under OCI. Should be charged under OCI. Okay, so why OCI? OCI is just to protect your PL from unnecessary fluctuations. Okay, I say it's a revaluation. For example, I have an asset, okay, of for example 1 lakh. But due to fair valuation, I say now my asset is of 250 lakhs. Okay, 250,000. Okay. See, there is a huge gain. You can say it's a gain of 150. That's a huge gain. Unnecessary, your PL will be overstated by this gain. This is unrealized gain. Please understand, this is not actual gain. This is just a gain due to fair valuation. This is just a gain due to fair valuation. This is not regular, normal, genuine, actual gain. So it says that please do not record this in PL. Instead, please charge it to your OCI. Got it? Why OCI? OCI is to protect your PL with unnecessary adjustments, with unreal adjustments. It says that all the notional gains and losses should be charged under OCI. Is it clear? Give me a quick thumbs up. Please ask questions. Good. OCI stands for other comprehensive income. Standards, specifically when we'll be reading all other 39 standards, we come to know that when a standard asks that, okay, go for fair valuation. Whenever it asks for fair valuation, if there is any gain or losses due to that, okay, we have to check. If it is asking you to record under OCI, then that difference of gain or loss will be charged under OCI. Okay, so the two parts are majorly done in order to protect PL with the unnecessary adjustments, okay, and to record all the incomes and expenses which are in real. Okay, everybody good with this? The total of PL and OCI is known as TCI, total comprehensive income. Keep in mind, register this. Okay. Just for an example, okay. For valuation purpose, when you're doing first time valuation, if you're going ahead with the revaluation model, okay, if you're going ahead with the fair value approach, revaluation model, so what will happen? Either the difference will be up value or down value. For example, your current asset is of $100,000. The book value or carrying amount, this is one and the same thing. What is carrying amount? What is book value? The value that has been recorded in the books of account against that item is known as book value, or you can say carrying amount. Give me a quick thumbs up. Do you understand what is carrying amount and what is book value? Okay. The amount that is recorded in your balance sheet is known as book value. The amount that is recorded in your balance sheet, okay, against that particular item is known as carrying amount of that item. Carrying amount and book value are one and the same thing. Ishan, is it clear? What is carrying amount and what is book value? Okay. Now, in case if you're doing fair valuation, if your asset is of 1 lakh, and if you're doing any fair valuation, either it will be equal to 1 lakh, or either it will be more than 1 lakh, or either it will be less than 1 lakh. Got it? If you're doing fair valuation, either the value will be exactly the same with the book value, or it might differ. It might differ in the upward way, it might differ in the downward way. Either it will be a gain, or it can be a loss. So if we are going ahead with the revaluation model or fair value model, then on the reporting date, either there will be upward valuation due to fair valuation, or there will be downward valuation. These are just examples taken. For example, your book value is of 1 lakh, and when you went for your upward valuation, it said that your fair value is of 1,20,000. The fair value is of 1,20,000. Okay, so we say that okay, record gain of $20,000 in OCI. Okay, this means what will be a journal entry? A simple journal entry will be property, plant and equipment account debit. Your property, plant and equipment account will be increased, will be debited by $20,000. Okay, 2, gain on revaluation. Gain on revaluation is known as reval surplus. 2, revaluation surplus. Okay, of $20,000. Of 20,000. Super important to understand. This is your balance sheet item. Whereas this will be shown in your OCI. So gain on fair valuation or revaluation surplus on fair valuation of PP will be shown as under OCI. Okay, just an example. Here we will show reval surplus, revaluation surplus, or you can say gain on fair valuation of PPE. This will be shown 20,000 over here under OCI. Give me a big thumbs up. Is it clear? Okay, this picture should be super clear. In order to make it clear, I have shown this structure beforehand. Okay. Next, it says that in case if we have loss, okay, because when the book value, the carrying amount in the books of account was 1 lakh, and you have done a fair valuation of, and the value was 95,000. This means there is a loss on fair valuation of 5,000. Okay. Standard says that record loss on fair valuation of PPE of $5,000 in PL state. It says that if there is any income, if there is any gain, please record under OCI. Why we are recording under OCI? Because this is not real gain. Instead, it is just a gain due to fair valuation. This is just a notional gain, unrealized gain, not actual gain. Whereas here, it's a loss. So why we are taking this loss? Though this loss is also not actual loss. This is also unrealized loss. But we are accountants and we follow prudence concept. We follow conservative approach. We say there are upcoming losses. If there are any upcoming losses, do make sure you are booking it then and there in your statements. Okay. Therefore, what will be your journal entry? Please tell me. What will be a journal entry in this case? What will be a journal entry? No idea. Patient says no idea. Okay, anybody?
Revaluation loss debit to PPE.
See, since you're reducing the value, you will decrease your property, plant and equipment. You will decrease your property, plant and equipment by $5,000. Okay, what to debit? This debit will be taken to loss on fair valuation of PPE. Debit of 5,000. Kishan, do you know how to pass journal entry? Is it all right? This loss on fair valuation will be shown under PL and this PP will be shown under balance sheet. Is it clear now, Kishan? Since it's a loss, see, you have recorded in the books of account. Your books were having balance sheet. Your books were having 1 lakh in your statement. Okay, just an example. Okay, in your balance sheet, okay, if we talk about, for example, 31st March 2020 and 31st March 2021. Just an example. Okay, for example, in your balance sheet, you had a property, plant and equipment shown as 1 lakh. Got it? Okay, this is your case 1. And for example, or case 2. Just an example. Okay, again in this case, your PPE is shown at $100,000. Okay. For example, on the reporting date, this is your latest reporting date. For example, on this reporting date, when you're preparing your financial statement, you move to fair valuation approach. And you said that, okay, if you're following fair value model, okay, let's fair value. For example, in our case 1, the value was 1,20,000. So this means your asset will be now recorded at 1,20,000. Got it? How will you record it? By passing a journal entry. That means increasing your PPE by 20,000 and simultaneously recording the difference to your statement of PL and OCI. Since it's a notional gain, do not record it in your PL. Instead, show it under OCI in this manner. Is it clear now? Are you able to connect? Good. Good. Okay, similarly, for example, in our case 2, if your fair value has been 95, this means your carrying amount was this. Now your carrying amount, now your book value will be 95,000 due to fair valuation. This means you have to reduce your 5,000 amount due to fair valuation. How will this fair value amount will be decreased? Okay, by decreasing your PP, by crediting your PP by 5,000 and simultaneous loss will be charged to your PL. Is it clear? Please raise hand in case of doubt. Please unmute in case of doubt. Any item, any amount, what is carrying amount, book value, what is reval model, what is fair value model, what is reporting date, what is upward valuation, what is downward valuation, why journal entry, why OCI, why PL. There can be any question. Please do ask.
Swati, one question. What will be the fair value and the normal value?
All good? No question?
Question.
Okay. Try to pass a journal entry. The carrying amount of property, plant and equipment is $10,000 and there is an upward valuation of $500 on reporting date. Okay, please tell me the journal entry. Please unmute and speak up, it's fine. Please tell me the journal entry in case number 1.
PP account debit 500, revaluation surplus 500.
Okay, good question. Okay, please also tell me this gain in value will be charged, will be shown under PL or OCI? Where it will be shown? Good, very good, very good. Okay, so PPE debit, that is by the difference amount of $500. Okay, to a reval surplus. That is $500. Okay, good. This will be shown in your balance sheet. This will increase your balance sheet asset, PP asset by 500. Good. And your reval surplus will be taken to your OCI, other comprehensive income. Harishankar, please confirm. Is there any doubt? Good, good. Okay, I want you to tell me the next entry. If carrying
Revaluation
amount of
loss.
PPE is $10,000, now, for example, there has been a downward valuation of $700. Record journal entry. Reval loss. Okay, revaluation. Okay, instead revaluation loss. It's debit, that is $700. Good. To PPE, property, plant and equipment will be reduced by $700. Very good. Okay, simple one. This will be shown under PL or OCI. Kishan, this will be shown in your PL or OCI. This will be shown under PL. Please understand. If there is a downward valuation, if it's a loss, then you always charge to PL. Then you always charge to PL. If there is a downward valuation, if there is any decrease in PPE value, and if it's a loss on fair valuation, then you always charge to PL.
Sorry, one question. Hello.
Is it confusing? Got it?
One
Kishan,
question.
is it confusing or have you got it?
I have one
It's a
question.
profit, charge to OCI. It's a loss, charge to PL. Regarding PPE, if you are doing fair valuation of property, plant and equipment, if it has a book value, okay, you have to compare it with the fair value. If fair value has difference as compared to the book value, okay, if it's a high value, this means if it's profitable, show this profit under OCI. Why under OCI? Because it's unrealized, not actual gains. Whereas if it's a loss, that means in case of downward valuation, okay, please record it under PL, and this will be a decrease in your balance sheet. Kishan, please confirm once. Is it clear? Please unmute and speak up. Got it now? Okay. Please again take a picture of the same. Try to revise it. Even in the day, if you are free, take a glimpse at it of it for 5 minutes and take it. Okay, what is happening? Why it is happening? Where it is affecting? Okay, so this is your first time revaluation. When you're recording your asset, in the books of account for the first time on fair value model using fair value approach. This is also known as revaluation approach. When the standard says that please record PPE at fair value, when the standard says that please record PPE in the books of account at fair value. Tomorrow we'll take up subsequent reporting. Okay, tomorrow we'll take up subsequent reporting. This means once you have done fair valuation, then what happens on the next reporting day? Then what happens in the next reporting day? Then what happens in the next reporting day? Okay, what is reporting day? The date on which you are preparing your FS. The date on which you are preparing your FS is known as reporting date. So this is your first reporting date treatment when you are following fair value approach to record PPE in the books of account. Okay, later tomorrow we'll see how to record this asset subsequently using fair value approach. Please unmute and speak up. Was this class helpful? Is there any anything that I could help with? Any question? Please unmute and speak up. That will be like very helpful.
So far, no questions.
So far, no questions. And if there are any questions, I will tell you. Am I audible?
Any question? Was this class helpful? Do you want me to stick to more basic? Do you want me to make it more simpler, or is it fine? Are you able to catch up? Kishan says, do you want me to make it a little more simpler? Okay. See, I generally use journal entries, okay, to make sure that what the impact is taken, the transaction is there, how the treatment is affecting your FS. So I think journal entry is a very good way to understand the entire concept of transaction, okay, in an easier way, but I'll still try if it's possible. Okay, Kishan, please do revise. Tomorrow we'll take up the ahead topic. Okay, which will be like we will be referring these topics again tomorrow. Thank you, Kishan. Thank you. Kishan says it was helpful. Hari Shankar, what is your status? Is this class helpful? Please unmute and speak up if possible.
Yeah, I am good.
Fine.
I am good with the class. It is. Hello, can you hear me?
Do you want me to make it more simpler? Kishan, we cannot hear you. I think you are on unmute, but
Am I audible? Am I audible?
Hari Shankar, I cannot hear you. Okay, good. Okay, so see you tomorrow at 7 a.m. Okay, also I give you a quick question for reference. Okay, I want you to try to solve this. I'll give a screenshot and I'll share it in the group itself. Okay, try to solve this question once and tomorrow we'll discuss. Okay, and also please, it's a request. Do make sure that you're revising this model because tomorrow we'll be trying the subsequent model. Okay, so you need to be very clear with the initial recording in order to make grasp the subsequent recording in a simpler way. Okay, see you tomorrow. Thank you so much for joining. Okay, thank you so much. You too. Have a good day. Have a great day actually. Thank you so much.